Bond yields continue to move south as the market builds some momentum here. Going back to the March FOMC, we've seen 10-year note yields pretty much on a straight shoot lower. Today we dipped below 210. Remember, the Fed effective range is 2.25 to 2.5, so we are sort of off the charts as far as where we are looking at things all being relative when we look at short end rates and long end rates. But we did take a step back, and we go back to November of 2016. You remember that month? That was the month that President Trump was elected. 10-year note yields were hovering right around 185 on the close of business on Election Day, and we rallied them all the way up as high as 3.25 in October of 2018. Now, we have since retraced almost 100% of that move. We're not quite there yet, but we are nearing. Once we get through 2% in the 10-year note yield, it's only a matter of time, probably days, before we get to 185, and that will signify the opening and closing of really a major chapter in the U.S. history here, as we've seen such a fast move from the levels we were at back in October to where they are now. And I think ultimately that could bring some pause. Now, the only thing that would cause this, obviously, is more uncertainty around what we're reading with trade and tariffs and how it's going to affect the global growth. Likewise, the stock market still hasn't seen a significant pullback, something that we would have expected if there was any kind of real fear out there. So I think ultimately right now, those are kind of what we're hinging on. More news out of the geopolitical spectrum. Likewise with the stock indices, yes, they're down, but they're still up significantly from November of 2016. And that would certainly throw a wrench into any sort of bond sellers' plans, because yields right now look to be moving at a pretty fast clip to the downside. And market volatility, yes, it is higher, continues to make new year-to-date highs. We even entered the 5% area in 10-year note, which is a level we rarely see. And if we do, it's really for a brief moment, especially over the last several years. So I think right now volatility is a very good signal. Obviously, there's still concern, caution, whatever you want to call it, and the market, as we continue to push yields lower and sort of away from the norm, that is going to continue to happen. Volatility higher here as yields go lower, and lower they are. So right now we have lower yields, we've got higher volatility, and let's talk about the Fed here. What has their message been? Really going back over the last several months has been patience, right? The Fed wants to be patient. Let's let things happen. We'll remain data dependent. We'll watch inflation and growth, and we'll see what's going on in other areas of the world. But they want to sit back and wait and watch. Well, today we heard from St. Louis Fed President Bullard, a non-voter at this FOMC, but certainly someone who's been around and knows how this works. And he talked about the need for a cut. The first real words we've heard from the Fed about the need for a cut openly. And I think that's really going to shake things up, because obviously with June FOMC right around the corner in a couple of weeks, that could change the dynamic very quickly. Last week there were some stories talking about economists coming out with rate cuts by September, but now we could be seeing rate cuts by June. Something that I don't think anyone expected a week or week and a half ago. So right now things are still very much alive and changing in the market as we continue to see bond yields go lower, volatility higher, and now we're expecting a rate cut sooner than we may have thought. So things are definitely not settled and won't be settled for quite some time. Certainly all the talk of trade and tariffs between not only U.S. and China, U.S. and Mexico, but now we throw in India and Australia, and there's a whole lot of uncertainty out there, and the Fed now has to step in and do something. Not only because the market's pricing it in, because now they've said it. Let's not forget the old adage. The Fed raises rates when they want to, but they cut rates when they have to. Seems to me there's going to be some cutting sooner than later.